Good evening, everybody. Happy Sunday. It is May the 1st and the start of a new month after a brutal end to the month of April. So let's get started. Let's talk money. Let's talk Sunday market preview. All right, everybody. So first of all, thank you all for taking a look at my video, stopping by, sharing your Sundays with me. And if you like what I have to say or you appreciate my videos, please feel free, like, share, subscribe. I'm going to try to keep everybody on the right side of this market as best as I can and do my best for you out there. But let's have a look at the markets last week. So the markets finished significantly in the red overall. Taking a look at the NASDAQ, which was down, real estate was down almost 4.8%. That was partially because of interest and inflation fears. We have materials and energy that actually finished the least worst of the bunch. And they actually finished relatively decently, very, very close to neutral. Looking at the S&P actually breached a critical value, which I told everybody about last week, and I even talked about it on Monday, that if we did breach March's low, we can almost expect further lows. Now, we did breach that, and I was hopefully anticipating, or I was being hopeful in anticipating a little bit of a market upside there. Like I said, a couple of days here, the markets did have very good solid setups for positive days. And in fact, we got a really good day. We just didn't get any follow through on Friday. But we'll talk about that as well. Continuing with the market, the Dow is down about 10.4%, which technically brings it about 0.4% into correction territory, which is basically anything between 10 and 20% in the negative. Now, I do believe that the Dow still has some strength here, but we'll have to see on the follow through tomorrow and Tuesday on whether or not it's going to continue to the downside, which at this point very well could happen. After all, we did breach that March low on the S&P. Now, if we take a look at everything else, the 10-year yield, which is really what I want to focus on, again, as every single week, was relatively stable with the exception of the peak on Friday. And by being relatively stable, it essentially means that the debt market is remaining intact. Now, as I keep telling you every single week, the reason we watch the 10-year yield is because if we start to see explosive movements to the upside, back to back, 4% increases, then we know that the market or the debt market is getting ready to collapse. Once that debt market collapses, we are going to see utter annihilation in the market. And I mean absolute destruction, well in excess of 50% correction. But I don't want to scare anybody yet because that's not what I do. So the problem with the markets last week, let's take a look at Friday. So Thursday, we had a great rebound there. We were sitting up several hundred points. Friday looked very good in the morning. It started to look like we were going to have some follow through to the upside, pushing away from that March low. And then we had geopolitical commentary come out, and always with geopolitical commentary, the markets did not like the term nuclear, which ended up pulling it back very, very significantly. On top of all the economic numbers that came out, which to say that the economy here, the US, globally, is anywhere near any kind of recovery, or if there's any positives out there, would be an absolute lie, which is actually what we're getting from a lot of people, including Biden himself, which after all the poor economic numbers decided to come out and say the economy is growing, even though GDP actually shrank. We'll leave that there. But still, the 10-year yield didn't collapse, or the 10-year yield didn't spike, causing a collapse in the market. Instead, it remained relatively stable. And yes, throughout the week, we had the US dollar's relative strength go all over the place. Stayed very high. I think at one point it was almost at 104. Still, the 10-year yield remained stable, which indicates to me that the potential for a major market collapse here, I'm not talking about small corrections like we're seeing now. A collapse is still very slim. Now, that could change. We can absolutely get a black swan event. And I do believe that there is one probably on the horizon. Not sure where it's going to be. I have a feeling it'll continue to be along the lines of supply chain issues, but we don't know. But let's take a look at this week, because I really don't want a very long video this week. This coming week, we have a lot of information and data coming out. We also have the Fed interest rate decisions on Wednesday. Now, the markets have already priced in a 50% or a 50 basis point increase. If we do get that, there is a good possibility that the markets may react well, since inflation continues to be a fear element here and part of the fear trading. If we do get that and the markets do see a bounce, that'll actually be very positive. And then again, we'd look for some follow through in the next 2-3 days to see if that momentum to the upside continues. If it doesn't, and we do not really break that March low, which is now a level of resistance, because previous support becomes the new resistance. If we go and barely breach and fall back down, you can pretty well feel comfortable in knowing that the markets are actually going to pull back further. So that's a major mark that we are going to watch out for. However, on the positive side, the 10-year or the interest rate decision by the Fed, 50 basis points is where we're looking. That could move the markets up, keeping in mind that really this is going to do very little to the actual fight against inflation, because as long as inflation or the interest rate does not exceed the rate of inflation, there will do nothing to the rate. In fact, it'll actually accelerate inflation faster. And if you don't believe me, let's take a look at the Fed's balance sheet. Now, I did have a chart. I'm not going to pull it up. I actually pulled it off from the Fed's website directly, and it shows money printing right across. One thing we do know is that the issuance of debt, or the printing of money, and yes, every dollar printed is a debt element. Every dollar printed is being used to also buy assets. So it is a cycle that's going around and around and around. And that natural cycle of this buying and printing is what's causing inflation to actually accelerate. This, with inflation, with the small increases in interest, keeping in mind, for every dollar printed to fight inflation through the use of interest rates, is essentially requesting or requiring additional money to be printed to pay for that increase in interest rate. So you see, it's a cycle, it's a circle, it's a never-ending printing press. I digress a little bit here. One thing we do want to know is we want to get ready for a lack of resistance or slowdown on the printing by the Fed, and a lack of actual adjustment to the balance sheet. It's just not going to happen. Now, there are many assets that are coming to maturity this year. I believe the number is somewhere in the $300 billion mark. So yes, those will come off the book naturally. However, that being said, as far as aggressively trying to remove additional assets, it's just not going to happen. The economy is collapsing here, the US, and abroad. And one thing we do know is that the Fed is going to end up in a very delicate position where they have to either stop interest rate increases or continue to push and allow the economy to go into a formal recession, and then eventually bring interest rates back down to pull the economy back out of that recession. A very dangerous and delicate game, which we've seen in the last 5 years. Indicators that the economy is collapsing, well, we have home foreclosures, which have increased over 100% year over year in the United States. We have PMI, which is absolutely dropping. We have GDP, which is absolutely dropping. Initial jobless claims have increased. It's just not very good. We haven't had a lot of positives in a very long time, and the markets don't seem to care. Anyways, let's take a look at this week. So this week, here's what I'm thinking. The markets have a chance here to rebound. I will be looking for the Fed interest rate decision. Prior to that, we're going to see extreme volatility. After that, after the decision, that's where we're going to see a direction taken by the markets and traders. If we see a move to the upside and there's no outside interference, you can expect that the markets will continue to move to the upside. If we do not breach March's lows and hold that number, the markets will pull back. Looking at cryptocurrencies are still in the red over the weekend. I'm not really, again, expecting a heck of a lot here from cryptocurrencies until at least the Fed decision on Wednesday. Depending what happens there, cryptocurrencies may act accordingly to see where cash will flow from market to market. I am still watching gold, as gold's volatility has really kicked up, as well as most precious metals. Commodities, still keeping an eye there. I do feel that commodities will have a positive swing, but overall, it really comes down to the Fed's decision on Wednesday and how the market digests that information following with the FOMC meetings. But that's it, everybody. I know I jumped around. You know my recordings are never scripted, so I never have a solid idea of what I'm going to say except what are on my notes. Again, if you like, please feel free to like, subscribe, and share. That's it, everybody. I will see you this week because I do plan on posting more to YouTube. That's it, everybody. I will see you at the opening bell.